Mike Singleton, you are the Senior Analyst at Invictus Research, a relatively young research firm which focuses on macroeconomic trends and the business cycle, two very important factors when making investment decisions. Thank you so much for taking the time to talk with me today.
My pleasure, Logan. Thank you for having me.
Yeah, so Mike, I'd first like to give you a chance to talk about what you offer with Invictus Research, and also to explain just the significance, the necessity to focus on the macro factors, the business cycle, rather than letting oneself be drawn into the day-to-day action.
Okay, I'll try to keep this succinct. So what we do at Invictus is we aim to provide world-class research on the business cycle. We aim to keep it very, very simple. We explain all of our ideas in 5 to 10 minute videos every day. We think of them as sort of a replacement for the business section of the newspaper. I think every investor has heard Warren Buffett say that he reads 8 newspapers a day. And so when you're early in the business, you feel like you need to do that too. Read Bloomberg, read the Wall Street Journal, read Deal Book, try and spend the first 30 to 60 minutes making sure you're up to speed. And in my view, that is pretty much a waste of time. Most business news is just entertainment news masquerading as business news. And we think that most investors would be much better positioned if, instead of reading the newspaper, the business section, for 30 to 60 minutes, or watching CNBC, if they take 5 or 10 minutes instead and consume something more like Invictus to get a feel for where we are in the business cycle, where we're going next, and what the implications are for forward returns in the various asset markets. And in my view, the business cycle is one of the most understudied but highest impact disciplines within finance, if I can use that phrase. So at my old job, I used to work for a private investment firm called Broad Run Investment Management. Fabulous experience. I would, travel around on the street, go to conferences, talk with other investors, and I saw that a lot of these investors were really, really smart, particularly on the buy side, right? And when they would get a call wrong, it was rarely because they didn't understand the business. Let's talk about equities. It wasn't because they didn't understand the business well enough or because they were stupid. It was usually because they were missing the forest for the trees, right? Because they were so focused on their niche, technology stocks, consumer stocks, industrial stocks, maybe they specialize in commodities or whatever. They're so focused on their niche that they missed out on the bigger picture. They missed out on the business cycle. So, they would be telling people that they should be going long cyclicals as growth was slowing. Big mistake. Go long in tech when monetary conditions are tightening. Big mistake, right? And they didn't realize these things until after the macro had already hit their stocks pretty hard, right? And the irony is, if you asked these people probably one by one, hey, do you believe in the business cycle? All of them would say, yes, of course, everyone knows there is a business cycle. Everyone knows the economy cycles. But they didn't have a way to integrate it organically into their research process. And so that's kind of the idea for Invictus, right? We'll do all of the legwork around the business cycle for you, and then we'll deliver it in these sort of short, interesting 5 to 10 minute videos every morning.
Yeah, that sounds very valuable. I know that personally, it's been a journey of finding what resources to look at, what to not look at, just almost putting a filter out there, finding what works and what doesn't work. So that's very valuable. If you don't want to, spend the time, a matter of years for me, figuring that out, if you want a really easy thing to go to, I really recommend something like what Mike is offering. But Mike, I next want to just dive into more with what you mentioned prior to this actual interview of how you view basically what your current assessment is on the markets and everything out there right now. I know that when you first started Invictus, you almost immediately began talking about the need to be cautious, the trend that was going to eventually happen of essentially a reversion to the mean of where we were back in 2021, which was anything but being at the mean. So maybe you could just talk about your views for, how you see the markets and everything right now.
So I hope I don't get a reputation for being a perma bear, because I'm not a perma bear at all. It's just sort of a function of when Invictus was founded, that it happened to be sort of as the business cycle was cresting. So I think to understand where we are in the business cycle today, it helps to go back and think about where we were roughly a year ago. So that would be the reopening, right? That's what was happening in Q1 of 2021 and Q2 of 2021. And that was obviously a terrific market for risk assets. The reason being that you had a great organic setup, you had the economy reopening, you had people sort of going out and about again on the back of the vaccines, you had a lot of fiscal stimulus running to the system, you had a fresh round in March, you had highly accommodative monetary setup, right? You had interest rates pinned at zero, you had $100 billion plus a month of QE, and that's a cocktail for tremendous performance from stocks. And that's exactly what we saw. It happened, if you were reading in a textbook, that's exactly what you'd expect. So what's happening now is you're seeing a reversion to the mean, like you just mentioned earlier. A lot of the tailwinds from 2021 are now becoming headwinds. So instead of going into the reopening and comping against the year the Earth stood still in 2020, now we're comping against the reopening, right? So we're comping against 12.2% real GDP print in Q2. We're comping against 30% year-over-year growth in consumer spending. Now, I don't think there's an economist in the world that expects the United States economy to accelerate off of base effects like that. The US economy just can't support it, right? So the organic setup is very, very different. These are probably the toughest base effects the US economy has faced, and as far back as I have data, call it 50 years or so. The fiscal situation is obviously not the same. So in 2021, we had fiscal stimulus, we had a fiscal tailwind. Now what we're seeing is fiscal drag. And the impact of that will probably continue to be felt through the end of 2022. And then, of course, the monetary situation is also very different. Instead of aggressive stimulation, you have the Fed withdrawing liquidity, right? You've got the balance sheet beginning to run off in June. We're at between 75 and 100 basis points. That's a quarter right now for Fed funds. And ironically, I don't think that the balance sheet or the Fed funds rate is the best way to measure the tightness of financial conditions. But the point is, directionally, everything is moving toward tighter. So that's our view for right now. We could talk about the nuances and where we expect things to change over the next few months, but that's where we are right now.
Absolutely. And I think yesterday with the Fed raising the federal funds rate 50 basis points, I think the highest in 20 years, that kind of really does play into what you just said of an almost extreme tightening from where we were. And you do expect this to continue, unlike a guest I had on just a couple months ago, David Hunter. I think his fundamental premise, assuming, with his melt-up thesis, is that, the Fed will not be able to continue to tighten, continue to raise rates much longer, just with how quickly the economy is decelerating. It seems like you and him fundamentally disagree at that one point. Maybe you could talk about that more.
So I don't know how much we disagree on that. So I think if I understand his view correctly, he is correct that financial conditions have tightened far more than most mainstream strategists and economists understand, right? So I think there are a lot of strategists that just look at the Fed funds rate versus inflation. They see, up until yesterday, they saw a quarter between 25 and 50 basis points. They see the balance sheet at all-time highs, and they say the Fed has not tightened at all. And that's just not true. The way that the Fed actually tightens now is through its communications policy first, and then through actually doing stuff later. So just by saying we're going to raise rates at some point, the Fed is tightening, right? And you can see that across the yield curve, right? You've seen the entire Treasury curve move up really, really aggressively. That's not because the Fed raised rates from 25 to 50 and then from 50 to 100. It's because the Fed's saying they're going to be really aggressive over the next year to 18 months or whatever. You're also seeing it in other ways. You're seeing it in a dollar that's been ripping higher. You're seeing it in credit repricing of credit risk higher, and basically more importantly than that is the private sector has just gotten much, much tighter. So the risk-free rate, private sector credit is basically the risk-free rate plus the credit spread, right? So you've seen risk-free rates go way up, and you've seen credit spreads reprice higher. What's the result of that? Much higher borrowing costs for the private sector. And if you actually look at the average borrowing cost for the average non-investment grade company, the interest burden has effectively doubled. So if these companies were to refinance all of their debt today at the prevailing interest rates right now, it would be much, much more expensive to service their debt and to pay interest on their debt. So that's another form of tightening, right? Yield curves have flattened. That's another form of tightening. So to say that the Fed hasn't tightened at all, I don't think is true. How much more can the Fed tighten? I do think that there is an upside risk case. We call it an upside risk case rather than saying that we're bullish, because it doesn't involve any fundamental improvement in the economy. The upside risk is something like the beginning of 2019 up until COVID, right? Something like the Powell pivot, where the Fed can no longer, or not that they can't any longer, but they no longer want to tighten aggressively, and they go into something more like neutral. And so then what you have is an environment where, growth is slowing but still positive, inflation is slowing but still positive, and monetary policy is neutral to sort of maybe leaning a little bit toward easing. And that's actually sort of a good backdrop for particularly long duration assets. So bonds, but also technology, also growth. And look, the S&P is 28% technology and 48% growth. So it has a lot of exposure to that upside risk. So it's certainly not out of the question that you could see sort of a rally in broad market beta. This is why I said that we could dive into some of the finer points of tightening financial conditions, right? Because clearly financial conditions are continuing to tighten, but we're reaching some points where it would be logical to see a little bit of a reversal, right? It would be logical to see rates start to encounter some resistance around their 2018 highs. If rates start to go down again, that would be symptomatic of easing financial conditions, right? If you look at where the Dixie Dollar Index is trading, it's trading right by, I think it's 4 or 5 year resistance. It's not uncommon for the price of tradable assets to encounter resistance when they reach places that they've traded at for long periods of time in the past. Again, a weaker dollar would be symptomatic of easier financial conditions. So that upside risk case certainly does exist. I think it's substantially larger than probably most strategists would say right now. But it's not something that I would bet on as being, it's not how I would position my portfolio. I wouldn't like go, absolutely long on all these long duration risk assets, because we're not seeing confirmation yet. It's just that we're approaching this point where, hey, it would be logical to see some easing.
Absolutely. Okay, I understand your view a bit better now. I don't know that David would necessarily say to go long, high risk assets either. Maybe he's just talking more in terms of what he sees as a forecaster, but not necessarily, what could be done or should be done. Yeah, I'm just curious as to your view on inflation right now. Obviously, inflation in March and April expected to be very high. But with a reversion to the mean, that would suggest that inflation would begin to come down as well with a slowing economy and an economy that actually in first quarter contracted. So just curious to hear your thoughts on inflation right now.
Okay, so I have a lot of thoughts on inflation. I've got my short-term thoughts and my long-term thoughts, and feel free to stop me if I start to ramble too much. But obviously we've had pretty bad inflation for the past year or so. I think it's important to ask why we've had it before we start talking about when it rolls over again, because it's hard to understand why something will change if you don't understand why it happened in the first place. The reason that we saw inflation was a combination of supply and demand issues. So you can think of inflation as the price of goods and services, right? And the price of anything is a function of supply and demand. So the supply of goods and services and the demand for goods and services. And we saw shocks through COVID on both sides. So on the supply side, we shut down global supply chains really, really quickly due to COVID. And then we tried to reopen them really, really fast. So that created all kinds of issues. On the demand side, we mailed out checks. We printed a bunch of money, right? So that boosted aggregate demand. So you saw higher demand and you saw lower supply. And if you just look at sort of a chart, that would raise prices, right? That's sort of your first day of economics class. The question is, are those things reversing? I think the answer is obviously yes. There's no impetus for any more fiscal stimulus. We know from just measuring it and sort of tracking it ourselves at Invictus that the impact of that stimulus is already rolling off, and it'll continue to roll off over the next 6 or 8 months or so. And then we pay pretty close attention to what's going on with supply chains as well. And according to our work, supply chain tightness sort of peaked around November or December, and it's been coming down since then. So our expectation is that supply is going up and demand is going down, and so price levels should come down as well. And the April inflation print would be a very logical place to see that happen, because you really begin comping some challenging base effects. That's when you really begin comping the, call it reopening inflation from last year. So instead of comping against 1.5% inflation from 2021, you're now comping against 4 or 5% inflation, and that makes a big difference, right? That's what, 300 or 400 basis points worth of base effects. Mathematically, that just has a big impact on how CPI is calculated.
Okay. And then you mentioned you have differing thoughts in terms of your short-term views on inflation versus your long-term views. Would your long-term views maybe be a bit more nuanced than what you just mentioned, which I think was for shorter-term inflation expectations? In the long term, do you have different thoughts?
So over the long term, we are also disinflationists at Invictus. And again, the way we go about thinking about it is we look at why we've seen disinflation since, call it 1980. And we ask ourselves, has anything fundamentally changed? So why have we had disinflation since the 1980s? Well, we've had a weakening demand backdrop in rate of change terms. America's gotten older, demographics have been weaker, fertility rates have fallen. We've also seen globalization, which obviously just make things cheaper, right? If I can buy something more cheaply abroad and import it here, then you're sort of importing disinflation, right? Wealth stratification is also disinflationary, right? Just because people with less money tend to spend more of their income on goods and services, whereas people with more money tend to spend more on financial assets, which does not affect the price of goods and services. Excuse me. High national debt to GDP is also disinflationary, right? So have any of those things changed? I think the answer is no, right? The demographic situation has gotten worse. People had less kids since 2019, basically, right? Fertility rates have gone down, not up. The national debt situation has obviously gotten worse. So that's not changing the way inflation works at all. Wealth stratification has gotten worse, not better. So nothing's really changed. The only thing that's changed is we printed $6 trillion and it just has to run its course through the economy. That's my view anyway. I understand that there are some people calling for regime shifts. Not our view. I appreciate the argument. And look, as we get more data, maybe our view could change on that, but that's just not the way that we see things right now.
Yeah, actually, one thing I was going to ask you later about was Zoltan Pozsar essentially hinting at another Bretton Woods type of situation. And you just mentioned that you don't think that's likely. Although there's other people who, say that it is almost inevitable that this does have to happen at some point. I guess, how do you see such a high debt load resolving without a reset of some kind? Or what kind of reset do you think that would look like?
Well, first, Zoltan is much smarter than I am. But two, so we have two parts to our process at Invictus, right? We have, I mentioned this before the show, but we have our fundamental outlook, which is determined by looking at the different economic data, Excel modeling, using common sense, and then we have what we call our market confirmation of that, right? We wouldn't invest in anything just based on the fundamental outlook. We need confirmation from the asset markets first. Why is that? Well, because trying to model the economy from the bottom up is extremely challenging, and people get it more wrong than right almost every time. And even at Invictus, we think we do a great job, but we're going to model the business cycle wrong from the bottom up too. The market, on the other hand, never gets the business cycle wrong, right? The market always gets the business cycle right, and it actually front runs the business cycle. So we would never make a new investment or suggest to our clients that they make a new investment without confirmation from the asset markets first. So regarding the dollar, admittedly, we definitely have a bullish bias on the dollar, specifically in the short term. But we probably wouldn't give this is going to sound maybe sort of short term, but we wouldn't give the bearish view, we wouldn't give the bearish view much weight until we start to see some sort of confirmation from that from the asset markets. And right now the dollar is ripping, right? Maybe Zoltan's forecast come true longer term, but I don't see any evidence of that right now. Global demand for the dollar is very, very high. And if we do see sort of a deflationary bust, which I think is very reasonable, right? If the Fed continues to tighten, there's still going to be demand for dollars because everyone needs dollars to buy commodities. They need dollar to service their Eurodollar debt. There's just no way of getting away from the dollar right now.
Absolutely. I think in the short term, probably most people would agree with you that the dollar, just with how it's been the world's reserve currency, is kind of almost, it will at some point go through some sort of a dollar short squeeze. I know Brent Johnson has referred to that a lot with his dollar milkshake theory, but I guess in the longer term, do you see any maybe changing dynamic? I know Russia, a very new thing, but in terms of they've been trying to have the BRICS nations transact with them with rubles. We don't know yet if that will actually happen, but it does seem like there's the just the potential for things to begin to shift, perhaps away from the dollar being the reserve currency. Ultimately, do you think that that is an overhyped view that, you know, the dollar is going to stay the reserve currency longer than people currently think? Or what's your assessment on that?
I think that's almost certain. I mean, you could make these bearish cases against it. You could make the bearish case against the dollar today. You could have made it 10 years ago. You could have made it 20 years ago. Timing actually does matter with respect to this. So, yeah, I would take the over. I think that the dollar system is going to last longer than anyone expects. I mean, the United States still has tremendous influence, still has an incredibly powerful economy. I mean, the military is really second to none. I mean, the cultural influence abroad. I mean, the political savvy. I know that might sound strange to some people, but the U.S. is run by people that are very good at putting U.S. interests first. So no, I mean, I think the dollar system will last longer than most people expect.
Okay. And then this is going back a little bit, what you mentioned with supply chains. I'm curious to see what the shutdown in China, if that affects your forecast at all, or your views with Invictus at all. Obviously, we'll have to see how long this lasts, but already it does seem that the whole reopening of supply chains has been a much bigger issue than I think most people would have imagined it could be. Would your forecast really change much if, for example, the supply chain issue wasn't to go away very quickly, or what are your thoughts there?
So I think that the Shanghai port issue and the zero COVID policy in China is clearly an inflationary force. You know, you can think of the inflation deflation or inflation disinflation debate as sort of a tug of war between two opposing forces. I think that the trend is going to be toward disinflation, but there's still going to be inflationary forces like the China zero COVID policy. I think what's really funny is I've heard a lot of people talking about how maybe China is doing this to disrupt the U.S. economy, to cause faster inflation, maybe to sort of induce a recession as the Federal Reserve tries to manage inflation down. And I think that's almost humorous. It's very funny. I mean, the situation in China is really, really bad. And if they are hurting themselves to try and hurt us, hurt the United States indirectly, I think that's probably, it's so misguided that I think it's almost impossible that China is actually doing that. So didn't really answer all of your question there. I'd been seeing that on Twitter and I thought it was really funny because I think that's almost impossible.
Okay, so unlikely that China's intentionally trying to hurt us with inflationary pressure by hurting themselves, their own supply chain. I'm curious what your thoughts are on commodities. Obviously, commodities have been very hot so far in 2022 with inflation running much higher as a result of Russia and Ukraine. Do you see commodities almost topping here, would you say?
Well, commodities don't have to, wow, it's a good question. Calling a top is always feels like a fool's errand. I will say that I think what we're seeing right now in commodities is more like the period of time between 2006 and 2008 than it is to something like the 1970s, right? I think the economic backdrop is much, much different, especially on the demand side. I mean, you could make the case the supply side is kind of similar, right? Because you had, OPEC creating supply side issues on oil. Maybe you have that with Russia today. But I think the reality is if the Fed wants to crush inflation by crushing demand, it can do it. It will do it if that's really its goal. And, if you look at the headlines from 2008 about inflation, they look incredibly similar to today. You had CNN blaming big oil companies for inflation, saying that there should be price controls on the price of energy. You had people complaining about gas prices, tons of headlines about it. And not that those things aren't real, they are real. But inflation went from, I think, 5.5% in July of 2008 to -2% in July of 2009. So you saw a 700 basis point deceleration in 12 months. And that's what happens when aggregate demand gets totally crushed. I'm not saying the conspiracy of circumstances will look exactly the same. But look, the Fed is saying that it wants to crush inflation. Everyone says don't fight the Fed on the way up. Do you really want to fight the Fed on the way down? It seems like it might be better off to just listen to what they're telling you.
Absolutely. So maybe we could finish up with just how you would advise people to look at the markets right now, what you would maybe see as attractive assets versus unattractive assets to include in their portfolios. Obviously not advice related, but just broad statements.
Sure. So our investment themes for the month of May were slower growth, which is being validated by the asset markets, slower inflation, which isn't yet, but we expect it to be in the next few months. Because it's not validated yet, we would not be expressing that view in our portfolio explicitly, or we would be making it much smaller, a much smaller portion of our portfolio. And then the third is tightening financial conditions, because financial conditions do continue to tighten. That said, we are approaching, call it a risk point, where it seems like it would be logical to see financial conditions kind of move backward into neutral. So the place where we have the most confidence is slower growth. And the way that you would express that, at least in the equity markets, would be to go long defensives and short cyclicals. So long things like large cap versus small cap, long, say, utilities or managed care healthcare, or maybe consumer staples, and short things like transportation stocks, regional banks, things that are really sensitive to economic growth. From a portfolio management perspective, we still like the idea of being sort of low gross, low net, big cash position, because look, this is a super, super risky market. And if we start to see signs that this upside risk scenario comes to pass, right, that financial conditions really are going to go back to neutral, and we're going to see something more like early 2019 into 2020, that would be a reason to probably reduce gross, increase net, and try and capture a little bit more of that upside, but we're not seeing it yet.
Yeah, so that sounds like a reasonable approach. Almost have exposure to both possibilities. Just don't be, leveraged to the point of being dependent on one thing to happen. For sure, you never want to be that way. But thank you so much, Mike Singleton, for joining me today. If our viewers want to find out more about Invictus Research and how to follow you, maybe you can let them know where to find you.
Yeah, of course. So our website is invictus-research.com, and you can also follow me on Twitter at InvictusMacro.
Okay, Mike Singleton, thank you for joining me today.
Thanks for having me, Logan.